Hello and welcome to our discussion on financial statement analysis. We'll try to answer this question today, that can a company with a positive, even with a positive ROI, destroy the shareholders' wealth? In order to answer this question, we will use the framework of EVA. EVA is economic value added is excess of NOPAT over the capital charge, and NOPAT is equal to profit after tax plus interest minus the tax benefits of interest. For the time being, we are not recognizing the accounting adjustments required for calculating EVA. So the NOPAT is PAT plus minus interest and tax benefits, and the capital charge is equal to the cost of funds, and the funds are equity plus long-term debt plus interest bearing current liabilities. So if the NOPAT is more than the capital charge, you'll have positive EVA. Then it will be said to have is creating the wealth. And if the NOPAT is less than the capital charge, then it is a wealth destroyer. So we will try to understand, can a company with a positive EVA, a positive ROE, have negative EVA? To do that, let us take an example. So suppose this is a balance sheet given, and this balance sheet shows there is a huge accumulated profits on the balance sheet. So that means the company is making accounting profits. And interestingly, it also given that the ROE of the company is increasing in the last 3 years, and for the year ending 2010 too, it has increased. However, the share price has not been increasing. So will EVA provide an answer or hint to this particular behavior of the market? The transactions for the year are very normal transactions. They're selling stock, they're making payment of expenses and depreciation on reducing balance, and there is a fair value of the market value of the plant is given. So let us take this example and start. First, we will try to calculate the return on equity as at the end of the year. But to calculate the return on equity, we have to prepare the financial statements. So the financial statements, the sales, entire sales 85,000 on credit. So entire sales 85,000 on credit. The corresponding cost of goods sold, entire stock sold. So at the end of the year, no stock available on the balance sheet. Then you paid salary for the period is 10,000 and rent for the period 12,000. So salary for the period 10,000, and you paid salary. So let us also put the opening cash in hand, and the rent for the period is 12,000. So the rent for the period also paid. Depreciation, it says depreciation is on reducing balance method. So depreciation is equal to 0.25 into the WDV of the asset. WDV of the asset 0.25 into the WDV of the asset, or the book value of the asset, So that is 0.25. So I'm sorry for that. So 0.25 is 5,625. So the accumulated depreciation increases to that extent. The cost of the asset is 30,000. It's given that the market value of the asset is 15,000, but if you see, the book value of the asset is 16,875, whereas the market value is 15,000, so there is an impairment loss. According to IAS 28, the impairment loss has to be shown in the books of account in the balance sheet. So how much is that? Let us calculate. So the book value of the asset is 30,000 minus the accumulated depreciation. The fair value of the asset 15,000. So the impairment loss is 1875. So impairment is a reduction in the value of the asset. So asset should be reduced to the extent of the impairment. So that gives us the PBIT of the firm. So PBIT of the firm is sales minus COGS minus salary minus rent minus depreciation minus impairment losses. Then interest during the period. Interest on the bonds for the full year 0.09. Interest on the short-term loan for the full year at the rate of 15%. So that, and let us assume that we pay off the interest as and when it is due. If we don't pay, create a liability. So that leads us to PBT. PBT is equal to PBIT minus interest, PBIT minus interest on bonds minus interest on short-term loan. And we are assuming the tax rate to be 30%. So PAT for the firm is 34 minus 10,320. So that gives us to 24,080. And let us assume that we paid off that interest fully. If no information given, entire PAT is transferred to the balance sheet and added to the accumulated profits or reserves. Since all transactions are done, let us find the cash in hand. So cash in hand is equal to opening cash, no receipts, opening cash minus payments. So cash in hand is 136,580. Cash flow statement done, income statement done. No change in the capital, no change in the bonds, no change in STL, no change in the creditor, and no change in capital work in progress. So your balance sheet tallies. Now with this balance sheet, we would like to find the return on equity. Equity at the end of the year is 163,580. So the return on equity is PAT divided by equity is 14.7%. So equity is 14.7. So that means the firm is having a positive EVA. Positive return on equity. But the industry average of the return on equity is 20%. So the company is not doing as per the efficiency or as per the comparison of the other players of the industry. In order to understand why the firm is not doing well, let us decompose this ROE into operation decisions, investment decisions, and financing decision, which are represented by PAT by sales, sales by total assets, and total assets by equity. That means we are trying to decompose ROI. So ROE is equal to PAT by equity PAT by equity, which is equal to PAT by sales into sales by TA into TA by equity. So PAT by sales is equal to this by 85,000. Sales by TA, which shows the investment efficiency, is 0.34, and total assets by equity, how is the asset finance? So, and if you want to check whether the summation, multiplication of this, the product of these three will be equal to their return on equity, and the return on equity is 14.7%. So therefore the ROE is equal to PAT by sales into sales by TA and TA by equity. But in order to understand which particular component of the PAT by sales or sales by TA or TA by assets is creating problem, there's a need to decompose each component once more. So we will try to find sales, COGS by sales. We'll find depreciation by sales. And this process is called the DuPont framework, which gives us the drivers of the return on equity, which shows what is driving or what is affecting, influencing the return on equity. If you want to manage the return on equity, it is necessary to know how is the return on equity affected or can be influenced. So DuPont chart gives us that framework. So these are the expenses to sales ratio. The industry norms which are given there, it shows that the cost of goods sold to sales is 12.5%, and here it is 12%. So the COGS is in line with industry. The other information not given, but interest is given. The interest to sale as an industry average is 6%, whereas here it is 13.6%. So there is every possibility that PAT by sales is low because his interests are high. Interest is high because you have huge short-term liabilities or short-term loans sitting on the balance sheet. So in order to manage the ROE, maybe there is a need to understand and manage the interest on sales, interest to sales ratio. Let us also calculate this sales by fixed assets. So sales by fixed assets is 30 plus accumulated and plus the capital work in progress. So that is the sales by fixed assets, and sales by current assets is stock, cash plus the debtors. But since we don't have the industry norms, we are not able to use these numbers now. The total assets by capital, which will show the relationship between the capital and the total assets, and total assets by equity is very low because equity, the accumulated profit is high. The industry norm for that is 10 times. That means in this case, this firm is having high accumulated profit. Maybe we have to examine why there is high accumulated profit. Is the company using that assets or using that money to create the profit generating asset? In this case, no, because a large part of the assets are in the form of cash. So retaining profit is not bad, but retaining and not using that profit to create investment means the company is sitting idle. So this may be one of the reasons why the market is not reacting positively to positive or higher ROE. You can see that huge cash sitting on the balance sheet. A good proactive manager can use this money to pay off the liabilities, can use the money to create some more asset, can use the money to pay off dividend and reduce the accumulated profits, in the process reduce equity, in the process increase return on equity. But despite all these limitations, this firm is having a positive return on equity. Our focus is to find out if there's a positive equity ROE, is that company going to have a negative EVA? That was the question with which we started. But before we get into EVA, let us also see whether the company is having positive EPS. So EPS is equal to PAT divided by number of shares. 48 is a EPS. The diluted EPS is here because there is a convertible bonds. So convertible bonds, since there is a convertible bond, you will have potential shares, and it is mentioned here that each share will be converted into each bond is converted into shares in the ratio of 3:1, in the ratio of 3:1. So therefore potential shares is 300. So the total shares, adjusted share, is 800. But because of the potential share, you need to make an adjusted PAT. An adjusted PAT will adjust for the convertible bonds interest minus the tax benefits of the interest, which is 0.30, into 900. So sum it up, you'll get the adjusted PAT, and adjusted PAT divided by adjusted number of share is the diluted EPS of the firm. So this firm has a positive ROE and positive EPS, both basic and diluted. But as we started our discussion, we want to understand that even if with a positive ROE, can a company have a negative EVA? To find EVA, we need to calculate NOPAT. NOPAT is a profit of an unlevered firm. So add back interest. We add back interest. So the interest, to remove the effect of the financing decision on the profit, and reduce the tax benefits of interest, you get the NOPAT. So NOPAT is equal to 31,850. We are getting this NOPAT by using equity of 163,580, convertible bonds 10,000, and short-term loan 68,000. The cost of equity is given. For most of our questions, we are taking 20% as cost of equity. The convertible bond rate, the coupon rate is 9%. So the cost of equity is, cost of debt for long term is 0.70 into 9%. So 6.3, and 0.70, that is the tax benefits, into 15%, so 10.5. So the capital charge is equal to summation of all these costs, which comes to 40,486. So that leads us to a negative EVA, because the NOPAT is less than the capital charge. So the firm is having positive ROE but a negative EVA. The negative EVA because the firm is having a NOPAT which is less than the capital charge. Why it is less? How to reduce this negative EVA, that we'll pick up in later one of our sessions. So by using 2,41,000 or 241,580 with a charge of 40,486, you are generating a return of 31,850. So you are earning a negative EVA. The firm is not able to generate profit to meet the cost of funds. The weighted average cost of capital here is the capital charge divided by capital employed, and here capital employed is a summation of all the interest bearing or a cost bearing funds, which is equity, bonds and short-term liabilities. So the WACC is 16.8%, but you are generating a return of 13.2%. So the return is less than the cost of capital. So the firm is losing money, which is equivalent to the EVA. To summarize, therefore, we can say yes, a company with a positive ROE can also have a negative EVA, and a company with a negative EVA means which is not able to generate operational profit equal to or more than the cost of fund. So those firms with a negative EVA are said to be the wealth destroyers. So it is necessary as an analyst not to just confine our understanding of return on investment or variations of return of investment, but also calculate the economic value added, which brings in the cost of equity and enriches the portfolio of the performance indicators to comment on the overall performance of the company. Thank you.